The 84% tariff imposed by China on U.S. goods, in direct retaliation to the U.S. government's move to raise its own tariffs to 104%, marks a significant escalation in the ongoing trade war between the two largest economies in the world. This aggressive back and forth is likely to send shockwaves through global financial markets, triggering uncertainty and heightened volatility. Investors typically pull back in times of geopolitical and economic tension, which could lead to temporary declines in stock indices, especially those with high exposure to international trade, including tech giants, industrial manufacturers, and consumer goods companies. The impact won't be limited to the stock market. Bond yields may drop as investors seek safe haven assets, and commodities like oil and copper could see price fluctuations due to fears of slowed global demand. For everyday consumers, this tariff war translates into higher prices and reduced purchasing power. As U.S. goods become significantly more expensive in China, American companies will lose competitiveness in one of the world's largest markets. Meanwhile, Chinese imports into the U.S. will also come at a higher cost, affecting everything from smartphones and electronics to apparel and household items. This inflationary pressure may push up the overall cost of living and force central banks to adjust interest rate strategies, which could affect mortgage rates, credit card interest, and personal loan costs. Businesses, especially small and mid-sized ones, will face tighter margins and difficult operational decisions. Companies that rely on components or manufacturing partnerships in China may be forced to seek alternative suppliers, reconfigure supply chains, or pass increased costs onto consumers. In the longer term, this could accelerate the global shift toward production in Southeast Asia, India, or even reshoring to the U.S., creating new investment opportunities, but also requiring significant capital expenditure and adjustment time. From a personal finance perspective, individuals should be cautious with short-term investments and consider rebalancing their portfolios to reduce exposure to sectors directly affected by trade tensions. Diversification across asset classes, regions, and industries becomes more important than ever. Safe haven assets like gold, U.S. Treasuries, and the U.S. dollar could provide some stability. Moreover, the Chinese yuan may weaken as China attempts to offset the tariff burden and stay competitive in global trade, potentially impacting currency markets and emerging market debt. This tariff war also raises broader concerns about global economic growth. If prolonged, it could lead to reduced trade volumes, lower GDP growth rates, and strained international relationships, ultimately increasing the risk of a global slowdown. For entrepreneurs and business owners, this is a critical moment to review supply chains, pricing models, and target markets. On the flip side, there are potential strategic opportunities. Industries like automation, AI-driven logistics, local manufacturing, and alternative export destinations may gain traction. In summary, while the short-term financial environment may be rocky and inflationary, those who adapt early, diversify smartly, and remain alert to global shifts will be better positioned to navigate this new economic landscape.